Hey everyone, this is Ed McGill, co-founder and partner of McGill Jungie Wealth Management. Again, joined here by the great Jason Kirchhoff, our director of investments here. How you doing, my friend?
Good, Ed. How are you doing?
Things are great. We got another update for all of our clients and friends across the country, and this one's interesting because we're going to be talking about headlines and what that actually means. And in our office, as I look out the podcast room, we've got two TVs on the wall there tied to the markets. Jason has one in his office as well. We're going to talk to you about how it can be dangerous looking at those headlines. And it makes me think, Jason, just recently, and I only had one client that called, but when the Iran U.S. war started, someone had looked at their statement in a very short time frame and said, Ed, I've lost X. And I said, oh, you sold everything? And he goes, no. And I knew he hadn't. I said, well, you haven't lost anything then. That's just, what the valuations of that day, and walked him through that. And he didn't make any changes. And now the accounts are higher than where they were, when he had called in. But there is a lot of short-term noise out there that can affect people's thinking. And you actually had an interesting term that you called and how to get off it. So why don't you talk a little bit about headline detox today? And we'll give some
Yeah.
other examples that are out there.
Yeah. And the whole idea behind this was what matters for long term compounding and meeting financial goals isn't always on the same page with what you're seeing in the headlines. And maybe headlines isn't the right term. Maybe that's dating me a little bit. Maybe it's tweet or an X or a blue sky or whatever social media you're on. But a lot of those things seem important at the time. But with just a little bit of retrospect, you can kind of see that they actually weren't meaningful or material to how your wealth can compound.
So how does someone detox themselves from headlines? Because you are correct that, we're in this environment where everything's on our phone or on our watches or different things. And the media is about clicks. So saying something positive usually is not going to get someone to open up the article. So you have a lot of negativity. How do we help clients detox themselves? And what are some examples of some headlines this year that really didn't pan out at all?
Yeah, in the commentary piece, I put a quote from Nassim Taleb where he talks about one of the best ways to cure yourself is to look at the prior year's headlines, and you quickly see that a lot of those things were ephemeral. Whether it's the panic over tariffs or DeepSeek, if you remember that the Chinese AI was going to take over the world, or even the government shutdown. While those things can be important, obviously, if you made investment decisions or portfolio changes based on a headline from day to day, that could be pretty detrimental to compounding.
Well, and it really is. And it makes me think there was an article just recently, not tied to this, but something similar where it was an article from 1995 that said within the next 20 years, I can't remember if it was Florida or California was going to be in the ocean within the next, 20 years. So if you'd made life decisions based on that, obviously that was not, that was not good for you as you design portfolios. Maybe talk about what we're doing at a high level to help clients understand we are reading and doing a ton of research and data, but how are we making portfolios resilient for the long term versus investing for the next short term crisis? Because there are
Yeah,
seemingly in the newspapers or tweets or wherever short term crisis every day.
right. And I think it's focusing more on those potential structural changes that could change some of the underlying assumptions that go into portfolio construction. So in the piece, I highlight four of them. And I know we've talked about some of them in the past, but at a high level, it's the rise of passive, as you see more and more investors not really doing fundamental research on companies, but just investing based on market capitalization. The debt, the size of the debt, and the fiscal constraints that we have. And while that's been a topic for years, obviously it keeps growing, and we're getting into a place where it gets very tricky to get out of. I highlight deglobalization, the trend to move from very efficient supply chains to more secure supply chains. So that could have pretty large effects on portfolio assumptions going forward.
Yeah, tell us what you mean by secure. Is that meaning that previously we were kind of like in real time? If you needed something, you ordered it. Now, what we saw with the pandemic, that if you didn't have storage or excess amounts locked up somewhere, it caused you to be at a disadvantage or potentially at risk. Is that what you mean by that?
That's exactly it. If you look over the past 40 years, corporations and governments have been looking at efficiency. What's the cheapest way I can get whatever it is, whether it's pharmaceuticals or energy? And typically that means you go to somewhere else and you rely on another country to provide those natural resources. But now, you mentioned the pandemic. That's a great example where we started realizing, oh, wait, we should probably develop and produce some of these things ourselves, or have what's called friendshoring, countries that we're in line with having the ability to provide us with those things. And I think that trend is just continuing. And I think the Iran conflict is probably a great example of how that will continue, where countries start looking at their where they get their energy from. And I think that's one of the reasons we think nuclear uranium still pretty attractive going forward, is that's a way to secure your energy needs for a long period of time without worrying about the Strait of Hormuz.
That's interesting. Then there was a fourth one. What's the fourth one?
The fourth one, it seems like it changes daily. It's AI. This one has been, if you look at the history of AI, like the Turing test. Have you heard of the Turing test?
Yeah.
The idea that how do we test machines to determine if there's human-like intelligence? That test was developed in the 1950s, right? So this has been a long time coming, but recent growth has really accelerated this trend. I was just reading an article about token usage, which is a good way to measure how people are using, how much they're using artificial intelligence. And just in the first 3 months of the year, it's gone up 250%. So rapidly changing. So what are the potential structural changes to markets from AI? I think obviously there's productivity changes, there's employment changes, and then even AI and how it hits the real world, right? There's potentially energy needs and material needs that could really be impacted by that growth.
No, that's interesting. Also, too, when you said the great rewiring and the deglobalization, but probably more from the debt piece, which we get the most probably questions about. Has the debt piece been what has maybe not caused us, but where we've added things like managed futures to maybe be more trend following in a certain percentage of the portfolio versus the normal stocks and bonds? Maybe talk about some of the things we put into the portfolio, because we're always looking to say, where are there risks in the portfolio against X or Y or Z? Talk a little bit about that.
Yeah, and I think that's the bottom line of this whole piece, is that it's not like we're going to be able to predict necessarily some of these themes and trends, but it helps us, it informs us of where our portfolios could be vulnerable. You mentioned the debt, and there's a lot of talk that deficits don't matter, and that's been the case for 20, 30 years as it's been growing. But at some point, it seems like we could come to a point where, like right now, we're spending 20% of federal tax receipts on interest alone, and that has been growing considerably. So it's getting into a very sticky situation potentially. And what that could lead to is those assumptions on the stock bond correlations changing. And that's kind of what we've seen more recently, is that they've been positively correlated. So to your point, adding things to the portfolio that don't move along with stocks and bonds, but still provide a good return, just increases that resiliency overall.
Well, that's awesome. And I think really the bottom line is, because you had sent me this, the headlines are designed to make you feel like you are missing something, kind of reactionary. But usually the things that affect the markets, move too slowly to make the front page. So if you think of debt, it's been accumulating over time. The deglobalization has, it didn't happen one day to the next, like Liberation Day with tariffs and different pieces. And maybe more of the headlines can have a short-term 1 or 2 day effect, but really the things that are going to affect the long-term projections of the market, are more slow-moving and true fundamental changes. Would you agree with that, Ben?
I think you summarized it perfectly.
Okay, awesome. Well, the last thing I would end with for those of you listening is 2 things. One, on our investment committee meetings, here at McGill Junkie, we're really fortunate that Ross grew up on the institutional investing side, managed a team that oversaw $60 billion. Scott McEachern grew up on the institutional side. Jason has an institutional background and worked for, a single family office. Then we have Carson and Justin on the operations and really the mechanics, what's happening here. Burke and Jack, that there are some very robust discussions and thoughts that are happening in these investment committee meetings, really to help think through, again, what are those potential risks? How do we build the portfolios? And you'll hear Jason say this a lot, to be resilient against really, you never want to say all market conditions, but just, be resilient against, market changes and fluctuations. So I want you to know that there's a significant amount of thought that goes into how we build the portfolios. And then the second piece is do your best to ignore the headlines, because they tend to be more short-term noise that are trying to draw your attention. And I love that line that Jason said, try to detox yourself from the headlines. There's better things to be focusing your time and energy on, and know that the team here at McGill Jungie is diving deep into those things every day. So Jason, appreciate your leadership and your excellence from the team. This is Ed McGill signing off for the next quarterly update. And Jason, appreciate you, my friend.
Of course, anytime. Thanks, Ed.